Jacksonville was Florida's unstoppable success story. Home values rocketed nearly 60% in just 3 years, and thousands rushed in for a taste of big city living without the Miami price tag. But when mortgage rates doubled and insurance premiums exploded, even the state's most affordable market turned shaky. Now, as the Jacksonville real estate market cools and confidence cracks, the governor of Florida is scrambling to contain the fallout. Because if this city falters, could the rest of Florida's boomtowns follow? The true story behind the governor's panic is about to upend what you thought you knew about the Sunshine State housing dream. Families packed up minivans in Atlanta, retirees sold condos in Queens, and remote workers traded the Carolinas' chill for the Florida sun. Between 2020 and 2022, Jacksonville became a magnet for the restless and the hopeful. A city offering the promise of big city amenities without the Miami price tag. The pandemic migration wave brought the largest inflow of new residents since 2005, as thousands left behind high taxes and cramped apartments for sprawling suburbs and riverfront neighborhoods. Military families drawn by the city's Navy bases and accessible VA loans found homes they could actually afford. First-time buyers who'd been priced out of Orlando and Tampa suddenly saw Jacksonville as their ticket to the American dream. For many, it was a simple equation: more house, less hassle, and a job market anchored by giants like Amazon, Mayo Clinic, and Deutsche Bank. The city's blend of coastal access, job stability, and a median sale price, still under $315,000 in early 2023, turned it into Florida's value play. Newcomers arrived from every direction. License plates from New York and North Carolina lined the driveways of freshly built subdivisions. School enrollments soared, local businesses thrived, and realtors juggled waiting lists. The influx didn't just fill homes, it fueled a sense of momentum, setting off a chain reaction that would soon push prices and expectations to new heights. By the spring of 2023, Jacksonville's housing market was running on pure adrenaline. Median home prices shot past $300,000 for the first time, capping a 60% leap in just 3 years. Bidding wars erupted over basic 3-bedroom ranches, with some buyers offering $25,000 above asking just to secure a contract. Open houses felt like auctions, lines out the door, offers written on the hood of a car, is fielding calls from out-of-state investors eager to buy sight unseen. Builders scrambled to keep up, pulling permits at a breakneck pace. In 2022 alone, more than 13,000 new residential permits were issued across the metro, the highest count since before the Great Recession. National giants like D.R. Horton and Lennar raced local firms to break ground on every available lot, while Dreamfinders Homes ramped up hiring and built entire subdivisions almost overnight. For a moment, it seemed there was no ceiling. Homes spent little more than 2 months on the market, and nearly 98% sold for at or above list price. New arrivals, flush with cash from pricier cities, snapped up properties before locals could even schedule a showing. Neighborhoods that once felt sleepy now buzzed with the sound of nail guns and moving trucks. The city's skyline shimmered with cranes, and the promise of endless demand convinced builders and buyers alike that the boom would last. But as records fell and expectations soared, few seemed to notice the warning signs gathering on the horizon. The cost of borrowing changed almost overnight. By late 2023, the Federal Reserve's rate hikes had pushed 30-year fixed mortgage rates to nearly 7%, the highest level seen in 2 decades. For Jacksonville's typical buyer, the numbers no longer worked. A $325,000 home, once within reach for a dual-income family, now demanded a monthly payment that had climbed by hundreds of dollars since 2021. The same mortgage that cost $1,400 a month just 2 years prior now topped $2,100, even before taxes and insurance. Buyers who had stretched to compete during the boom found themselves priced out by the new math. First-time buyers and military families who once counted on Jacksonville's affordability watched their pre-approvals shrink with every Fed announcement. Lenders reported that for every percentage point increase in rates, purchasing power dropped by about 10%. Sellers, still anchored to last year's record prices, resisted cutting their asks. But the pool of eligible buyers shrank with each passing month. The result? Homes lingered longer. Open houses grew quiet. And agents fielded more questions about rate buydowns than bidding wars. The adrenaline of the boom faded, replaced by hesitation and recalculated budgets. As mortgage costs soared, the city's housing advantage began to erode, setting the stage for a surge in listings and a market suddenly searching for its footing. By the summer of 2024, a new reality settled over Jacksonville's housing market, one measured not in soaring prices, but in swelling inventory. Listings multiplied across every corner of the metro. In Riverside and Mandarin, rows of for sale signs dotted lawns that had rarely seen a vacancy just a year earlier. Subdivisions built for the pandemic influx now found themselves with dozens of empty homes as the backlog of unsold new builds piled up alongside existing properties. The numbers told the story. The average home spent more than 60 days on the market by July, almost double the pace seen during the frenzy of 2022. Some listings, especially in outlying suburbs, lingered for 90 days or more without a single offer. Agents who once juggled bidding wars now fielded calls from anxious sellers, wondering how long it would take to move a house that had seemed like a sure bet. According to local realtors, open houses drew a trickle of visitors, and price reductions became routine. One agent described it simply: when homes sit, buyers start to wonder what's wrong. That hesitation spreads. Inventory growth wasn't limited to a single price range. Starter homes, mid-tier builds, and even luxury listings all saw their days on market climb. By mid-2025, Northeast Florida's active listings had surged by nearly 18% year over year, reaching levels not seen since before the pandemic. With more choices and less urgency, buyers negotiated harder, sometimes walking away altogether. The market's momentum, once a force of nature, now moved at a crawl, setting up the next chapter, a reckoning on price. Median prices in Jacksonville turned negative for the first time in years, slipping 4% from their 2023 peak. Sellers who once fielded multiple offers now faced a different reality. Price cuts became the rule, not the exception. The average home, which sold above list during the boom, now closed at just 96% of asking. In some neighborhoods, sellers dropped prices by $15,000 or more to attract buyers wary of rising costs. The sale-to-list ratio, a key barometer of market confidence, slipped to its lowest level since 2011. Brad O'Connor, chief economist for Florida Realtors, put it bluntly: median prices dropped by 4% in April. This is the largest year-over-year percentage decline since 2011. For families who bought at the top, those numbers stung. The modest dip didn't compare to Cape Coral's double-digit plunge, but the psychological impact was real. Agents fielded calls from anxious homeowners worried about shrinking equity. Investors who banked on endless appreciation began to rethink their positions, especially as rental yields flattened in oversupplied subdivisions. The days of automatic gains were over. Instead, negotiation replaced urgency, and patience became the new currency. Even builders, once riding high, started offering incentives, rate buydowns, closing cost credits, just to keep deals alive. The market's confidence, once unshakable, now felt fragile. Price cuts, longer listings, and a steady drip of concessions signaled a market in transition. As one local broker put it, "The easy money has left Jacksonville. Now, every sale is a conversation." Property tax bills in Jacksonville arrived with numbers few had seen before. After years of steady gains, county assessors recalculated home values at their pandemic peaks, sending annual tax obligations up by 10 to 18% almost overnight. For a family in a $320,000 home, that meant an extra $600 to $1,200 a year, money that wasn't in the budget when they closed. Some first-time buyers opened their escrow statements to find their monthly payments jumping by hundreds of dollars. Military families, many on fixed incomes, faced the same math. "We were already stretched," said one Navy spouse in Oakleaf. "Now it feels like the ground is shifting under us." But taxes were only part of the squeeze. In July 2024, three major insurance carriers, UPC, Weston, and Journey, announced they were pulling out of Florida, citing hurricane risk and soaring reinsurance costs. Within days, more than 38,000 policies across Duval and St. Johns counties were set for non-renewal. Homeowners started receiving cancellation notices by mail. For some, the shock came at closing. Deals collapsed when buyers couldn't secure a policy, or when last-minute quotes soared from $2,800 to over $5,000 a year. Agents scrambled to find alternatives, often landing clients in the state-run Citizens Property Insurance, where premiums were higher and coverage more limited. The numbers kept climbing. By summer 2025, the average homeowner's policy in Jacksonville topped $7,100 a year, up 12% from the year before, and nearly triple what buyers paid in 2019. In coastal zip codes, quotes reached $11,000 or more, especially for older homes or those with roofs past 15 years. Inland, rates were lower but far from stable. One broker described the new reality. "Every week, another carrier leaves. Every month, another family calls me in tears." The combined burden of higher taxes and disappearing insurance options forced hard choices. Some sellers offered steep concessions just to close. Others pulled listings, unable to afford the next step. The market's old promise of affordability faded, replaced by a new question: how much risk can families bear before the dream slips out of reach? FEMA's latest floodplain remap sent shockwaves through Jacksonville's riverfront neighborhoods. In August 2024, thousands of addresses were newly classified as high risk, triggering mandatory flood insurance for anyone with a federally backed mortgage. Local insurance agents spent weeks fielding panicked calls. For many homeowners, premiums jumped overnight: $800, $1,500, sometimes more, just for the privilege of keeping their loan. In neighborhoods along the St. Johns and Trout Rivers, the impact was immediate. Properties that once sat outside the flood zone found themselves flagged as vulnerable, their resale value slipping as buyers weighed the new costs. City planning officials described the change as one of the largest percentage increases in flood risk designations statewide, with some downtown zip codes seeing hundreds of homes added to the high-hazard rolls. The insurance market, already battered by carrier exits, struggled to absorb the flood of new policies. Private companies, wary of mounting hurricane and flood losses, tightened their underwriting or pulled out entirely. That left Citizens Property Insurance, the state-run insurer of last resort, to pick up the slack. By mid-2025, Citizens counted more than 26,500 active policies in the Jacksonville metro, up from just 8,000 5 years before. For many, Citizens was the only option left, but it came with higher premiums and stricter coverage limits. Agents reported that in some riverfront neighborhoods, more than half of all new policies were written through Citizens, and even then, approval could take weeks. The numbers told a story of risk rapidly repriced. In the newly mapped flood zones, median annual insurance costs soared well above $7,000, with some coastal zip codes facing quotes of $10,000 or more. Sellers in these neighborhoods watched as buyers backed out over last-minute premium spikes or failed to secure coverage at all. Transactions stalled, and in some cases, deals collapsed entirely. One agent described a summer of canceled closings and frantic renegotiations. Every time FEMA updates a map, it's like a switch flips. Suddenly, a house that was a safe bet becomes a question mark. Beneath the data, the human cost mounted. Families who had budgeted for their dream home found themselves facing bills they never expected. Military buyers, retirees, and first-time homeowners, all groups that once saw Jacksonville as a haven from Florida's extremes, now struggled to keep up. As the city's insurance crisis deepened, the strain moved from spreadsheets to kitchen tables. setting the stage for stories of hardship and hard choices in the months ahead. The Jones family thought they had it all figured out. In May 2022, they closed on a 4-bedroom home in Oakleaf, using a VA loan and a carefully mapped budget. Military paychecks covered the $2,200 mortgage, childcare, groceries, and the rest. Insurance and taxes were rolled into escrow, leaving just enough for Little League fees and the occasional dinner out. But by mid-2025, the numbers no longer added up. Their annual insurance premium, once $2,800, climbed to $6,000 after their carrier pulled out. Property taxes, reassessed at the market's peak, jumped by nearly $900. The lender's escrow analysis in July demanded an extra $600 a month, an overnight spike of $7,200 a year. There was no warning, just a letter in the mail and a new mortgage statement. The Joneses cut streaming services and postponed a family trip. Still, the math didn't work. Their emergency fund vanished in 3 months, swallowed by higher bills. When the base's cost of living adjustment failed to keep pace, they faced a choice: fall behind or list the house. Conversations at the dinner table turned tense. Their son asked why they couldn't afford football this season. Mrs. Jones took a second job at the commissary, working nights to cover the gap. Even so, the family fell behind on escrow by September, triggering warnings from the lender. They weren't alone. In new subdivisions across Jacksonville, families who bought during the boom found themselves squeezed by costs they never agreed to. For military households, the promise of stability, steady pay, affordable housing had unraveled. The Joneses debated selling at a loss, but listings in their neighborhood lingered for months. Investors who once snapped up rentals had pulled back, wary of rising vacancies and shrinking returns. The American dream, so recently within reach, now felt fragile, one unpaid bill away from slipping through their fingers. Institutional investors once treated Jacksonville's subdivisions like a sure thing. In 2022, companies such as Invitation Homes and Progress Residential snapped up thousands of single-family houses, accounting for as much as 12% of sales in some zip codes. Their spreadsheets projected endless rent growth and minimal vacancies. But by mid-2024, the calculus had changed. Insurance premiums soared, rental demand softened, and the promise of easy returns faded. Internal memos leaked in May 2025 warned of illiquid exposure if insurance turmoil continued. The response was swift. Bulk sales to local operators at discounts ranging from 6% to 15% off 2022 prices. In one deal, an investor offloaded 24 homes in a single transaction, accepting losses to clear their books. The retreat didn't stop with Wall Street landlords. Builders who had once raced to pour foundations now faced a glut of unsold inventory. Dreamfinders Homes, headquartered in Jacksonville, responded with deep incentives and tough decisions. In late 2023, the company announced layoffs affecting 12% of its workforce. Rate buydowns and closing cost credits became standard, but even these couldn't offset the drag of higher taxes and insurance. CEO Patrick Zalupski put the dilemma plainly in a spring interview. "We have to wonder if our model of perpetual expansion is viable in this new risk environment." Discounted investor sales and builder cutbacks sent ripples through the market. As institutional players pulled back, smaller landlords hesitated, and local contractors faced shrinking order books. The confidence that once defined Jacksonville's boom now looked fragile. Community meetings grew tense as residents questioned stalled amenities and unfinished parks. The easy optimism of the pandemic era gave way to anxiety, negotiation, and a search for stability in a market suddenly defined by uncertainty. Tempers flared in River Haven's community center as homeowners crowded folding chairs, clutching letters that spelled out new financial demands. The master-planned subdivision, once a symbol of pandemic optimism, now found itself at the heart of a neighborhood revolt. The Community Development District, unable to cover bond payments after months of sluggish sales and missed builder projections, imposed a special assessment. $2,300 per household. For families already stretched thin by rising taxes and insurance, the levy landed like a punch. Some residents, still reeling from last year's insurance hikes, now faced a choice between paying the assessment or risking a lien on their property. Anger spilled into public meetings. Residents lined up at the microphone, demanding answers from board members and developers. One retiree, whose fixed income barely covered her bills, described the assessment as a betrayal. Another homeowner, a Navy veteran, called out the original sales pitch. "We were promised parks, trails, a pool. Now we're paying for empty promises." Local news crews captured the shouting and the tears. Viral clips that spread across social media, fueling outrage beyond Riverhaven's gates. The impact was immediate. Several families listed their homes, unable or unwilling to shoulder the new cost. For sale signs multiplied on once busy streets, and by midsummer, vacancies in Riverhaven climbed to nearly 10%, a rate unheard of in Jacksonville's newer subdivisions. Foreclosure filings ticked up as some households fell behind, unable to refinance or find buyers in a market suddenly wary of special assessments. The sense of community fractured. Neighbors who once swapped landscaping tips now traded warnings about legal notices and collection calls. As frustration mounted, the protests became a rallying cry. Homeowners associations across Jacksonville watched closely, worried that Riverhaven's crisis could be a preview of their own. The city's fragile housing math, already stretched by taxes, insurance, and falling prices, had found its flashpoint. All eyes turned to City Hall in Tallahassee, waiting to see if anyone in power would step in before the unrest spread. Jacksonville's housing market now sits under a national microscope. Market analysts watching the numbers roll in from across Florida have singled out the city as the state's bellwether, a test case for whether affordability and growth can survive the combined weight of insurance turmoil, rising taxes, and climate risk. In the latest Redfin report, Jacksonville ranked third among all major U.S. metros for year-over-year median price drops, falling behind only Austin and Sacramento. Inventory has surged by 18% since last summer, even as other Sunbelt cities show signs of stabilization. Days on market in Jacksonville now average 72, up more than 20% from the year before. For economists, these are more than just statistics. They're warning lights. Phil Aitken, a leading local broker, points to the city's stubbornly high supply. More than 12,000 active listings by May 2025, nearly double the pre-pandemic average. Buyers have options, but sellers face a market where only 1 in 6 homes closes each month. National analysts echo the concern. Florida Atlantic University's real estate team calls Jacksonville the canary in the coal mine. If prices here can't hold, with job growth and in-migration still strong, then the rest of Florida's markets may be even more vulnerable. The sense of anxiety is spread from brokerage offices to City Hall. Policy groups and think tanks publish daily briefings, tracking every uptick in insurance premiums and each new carrier exit. Wall Street investors, once bullish on Jacksonville's steady returns, have begun to question whether the city's fundamentals are as strong as advertised. The city's reputation as Florida's affordable outlier now hangs in the balance. If Jacksonville stumbles, analysts warn, it could set off a chain reaction, one that stretches far beyond the banks of the St. Johns River. Governor Ron DeSantis arrived in Tallahassee on a humid August morning, flanked by senior advisors and a cluster of state regulators. The headlines from Jacksonville had grown too loud to ignore: insurance cancellations, stalled home sales, and a drumbeat of anxiety from both realtors and homeowners. Inside the Capitol, the governor convened a closed-door session with top executives from Citizens Property Insurance, the state's insurance commissioner, and legislative leaders from Duval County. The agenda was blunt: stabilize the insurance market before the crisis spread statewide. Citizens CEO opened with new enrollment figures: over 26,500 active policies in Jacksonville alone, triple the number from 5 years earlier. The state's insurer of last resort was now the only lifeline for thousands. But its growing exposure threatened the state budget if a major storm hit. Regulators warned that more private carriers were preparing to exit, citing reinsurance costs that had doubled since 2022. The numbers landed with force. In the past year, average annual premiums in Jacksonville had jumped to $7,100, with some coastal homes quoted at $11,000 or more. Each new policy written by citizens shifted risk away from Wall Street and onto Florida taxpayers. DeSantis pressed for immediate solutions. Advisors floated a temporary state-backed reinsurance fund to shore up citizens' balance sheet and calm the market. The insurance commissioner cautioned against a broad premium cap, warning that it could trigger further carrier exits. After hours of tense debate, the group approved a plan to expand the state's reinsurance pool and raise the cap on citizens' enrollment, hoping to buy time for the private market to recover. The governor left the meeting without public comment, his staff working to project calm, even as the sense of urgency lingered in the halls. For Jacksonville homeowners, the outcome offered little comfort. Stability remained a promise, not a guarantee, and the risk of deeper trouble still hovered over the city. A week after the governor's insurance summit, headlines trumpeted a new round of relief. The state's $1,000 homeowner rebate began landing in mailboxes across Jacksonville, pitched as a lifeline for families squeezed by rising costs. The checks arrived with fanfare, a glossy letter from Tallahassee, a promise to ease the burden of runaway premiums and tax bills. Yet for many, the numbers barely moved the needle. In neighborhoods where annual insurance costs now top $7,000 and property taxes had climbed by $800 or more, the rebate covered a single month's escrow hike, then vanished into the next bill. Behind the scenes, lawmakers wrangled over a permanent fix. The most heated debate centered on the property tax cap. After months of lobbying from realtors and home builders, the legislature approved an 8% ceiling on annual assessment increases for primary residences. Supporters called it a victory for middle-class homeowners. Critics, including Jacksonville's mayor and housing advocates, warned that the cap would do little for renters or long-term residents whose values had already spiked. Some argued it would only delay the inevitable, leaving schools and emergency services to grapple with shrinking budgets as inflation outpaced tax growth. Insurance remained the wild card. Citizens' property insurance, now covering more than 26,000 homes in the metro, faced mounting pressure from both storms and solvency rules. Analysts warned that a single major hurricane could wipe out the state's reinsurance buffer, forcing tough choices on payouts or future coverage. Climate models projected a 30% increase in severe storm risk over the next decade, raising doubts about whether even the most generous rebate or tax cap could keep up with the pace of change. Policy critics grew louder as the stopgap measures took effect. Housing groups questioned whether short-term relief masked deeper vulnerabilities, pointing to the surge in cancellations, stalled sales, and families teetering on the edge. The governor's office insisted that stability was within reach. But in Jacksonville's living rooms, the sense of uncertainty lingered, and the question remained: how long could these measures hold back the tide? By mid-2025, Jacksonville's median home price had fallen about 4% from its peak, a modest downturn compared to other Florida markets. The data shows a clear cause. Mortgage rates doubled to near 7%, inventory climbed, and average insurance premiums rose over $6,000 per year. These shifts strained families, drove some investors to exit, and put pressure on local builders. Yet many questions persist, such as how long insurance carriers will remain in the market, and whether recent state policy interventions, including proposed $1,000 insurance rebates and tax cap debates, can provide lasting relief. Official records confirm rising property taxes and the rezoning of thousands of homes into higher-risk flood areas, but the full impact on long-term affordability is still unknown. As Jacksonville's experience now shapes statewide policy, the evidence points to an uncertain future, one where resilience, not rapid growth, will determine the city's path.